had a great holiday for July 4th. Didn't have a whole lot of time to write a Substack article, but I'd like to go over the data with you guys. This is from Bank of America, and this is showing that the institutional clients were the biggest sellers. Retail and hedge fund clients were also sellers. So, we retail was buyers for a long time, and we bought the dip, and institutional people did not. Well, guess what? They still haven't bought the dip. They're still underweight. Um, yeah, we're getting to a point where we need a pullback in the market, but I don't think the pullback's going to be like a big pullback. Um, I think these institutional people are going to jump on it. And let's see, this is from RBC. Let's see. There we go. And it says the S&P's intermediate term trend and weekly momentum indicators tracking 1 to 2 quarter swings remain positive, suggesting further upside for equities. Our expectations, however, is that momentum indicators will move into overbought territory heading into mid-quarter 3 in the heart of earnings reports, with a pullback into late quarter 3 likely consistent with weak seasonality. So you can see how this red curve. This is what they're looking at. We still have room to run into mid-quarter 3 and then kind of a rollover is what they're looking for. Um, Short-term trend remains positive following the breakout to new cycle highs, with the first support 60.59 to 61.47. So if you're looking for a pullback, right? You could throw in a fib line here and see how they're looking at 60.59 to 60.47. That's basically in here. And if you look at this from a fib level, trying to buy it off the 50% 618 area, that's where I would like to buy a pullback. So mine's a little bit bigger. So mine's like right there. That's where I'm looking to buy a pullback if it happens. Let's see. So this was Barclays. They were talking about Stanley Black and Decker, and they gave it a new price target of 90. And just know that whenever rates start coming down, these companies are going to move big time, and it's gonna happen all at once, just like Baba. So it's like, well, why not wait until rates start coming down? Because it's going to happen very quickly, and I can't. I'm not that good at timing the moves, right? It can happen very quickly. This is just talking about lithium price with ALB. This is Intel, company update. They made it outperform. Um, you can read this. Here's the other one for if you want to read it for the recording. You can pause it there. Now, this is U.S. continuing jobless claims climbed the highest level in 3.5 years. Do you guys remember the dual mandate of the Fed? Oops. The dual mandate of the Fed is jobs and inflation. So there's your SPY break of that low. So again, just I know this doesn't have to do with the recording, but we were trading this. So I want you to understand the reason I'm stopping out here is because if it breaks here, the odds of it breaking down here are higher because of this breakout. If this breakout didn't happen, then it could have a higher chance of holding for a inverted head and shoulders. Um, okay, so here's PCE. What's the target rate? Do you guys know what does the Fed look for on PCE? They look for 2%, right? Have we gotten to 2%? The answer is no. So why is everybody saying the Fed needs to cut? Or why do you have people like me saying the Fed needs to cut? You do have a lot of people saying they don't need to cut. Well, the reason that I say they need to cut is because we actually need to run inflation higher than 2%. Can anybody tell me why? I told you guys this a thousand times. Why do we need to run inflation hotter than 2% for about 5 years? What is that doing? Yeah, it's a deficit, right? So it helps us inflate away our deficit. We have to pay back much less money, right, than if we don't. Um, this was one that I thought was really interesting. It's here. I don't think I have it all the way in here. Let's see. Yeah, there we go. So this is the S&P 500 on the cusp of the seventh breakout since 1990. Seventh great breakout since 1990. S&P breakouts a number of stocks at all-time highs. What do you guys notice about ours, the one that just happened? It's way less, right? You only have 22 number of stocks at all-time high. So what does that mean? Well, what it means to me is you've got a few companies that are really pushing it, and those companies are heavily outweighing it. Think Mag 7. And you've got a lot of companies underneath the surface that we can go after, right? So who do you guys think has a higher PE ratio, the S&P 500 or the RSP? Do you guys know what the RSP is? Right? Who do you think has a higher ratio, the SPY or the RSP? Well, the SPY does by a lot, right? And well, what does that mean? Well, what it means is you can buy the RSP at a much lower multiple than you can the SPY because this is an equal weighted ETF versus the weighted SPY. And so if you are buying the SPY, you're buying a lot more into the Mag 7, right? So anyway, long way of saying there's a lot to still do, and there's a lot of companies that can continue to rise, even though the SPY is at all-time highs. This is just showing the first half of July is the best time of the year, right? Second half is right here, but this is usually the best time of the year. It's called Christmas in July. Now this is just showing that the U.S. doesn't always win. This is 10-year annualized relative return of U.S. versus the world, and you can see that it goes back and forth, and the U.S. has been winning a lot lately. But just like I said at the beginning of the year, I think emerging markets are going to have their day in the sun, and it's not going to be just a 1-year deal. I think it's going to be over an extended period of time. That doesn't mean the U.S. is going to perform badly. I just think it will underperform comparative to the rest of the world. Well, certain sections of the world. This one's just showing that dividend is inexpensive versus history. And dividends are being ignored by managers. Again, that's your SWKs of the world, right? They will have their day in the sun. So growth versus value near ex-COVID highs, right? I think we're going to be putting in a lower high here. Maybe we don't. Maybe we come back up here and put in a higher high. But I personally think that we will put in a lower high here, and start to turn back down. This is supply of the homes are the highest in a once hot market. Does anybody live in Florida or Arizona? Lots of lots of listings. But one of the things to understand is I don't think we're going to have a housing crisis. We just don't have the same setup that we had in 2008. I think like 30% of homes are paid off, and then like 80%. I think I've got it in here. Have a loan under like 5% or something like that. Do you guys have a do you guys have a lot of homes for sale around you guys? And so this is again just showing July's seasonality. We haven't had a negative July since 2014. And this is just showing the number of days it took to get back to all-time highs. Um, you know, the thing to remember, guys, about this pullback that I was telling you guys to buy, what you always have to do with data is you have to ask yourself, is this going to be lasting, and is it going to change the way things are done? So much so that it will enter us into a recession. And if you thought we were going into a recession, then yeah, don't buy. I didn't think we were going into a recession. So when you get these dips and you don't think we're going into a recession, buy it. Like that's where you buy. This is just again talking about institutional clients being sellers. Yeah, just retail. This is just showing that post-election years have been strong. Um, so past 10 cycles since 1985, they've averaged 18.1. Wow. So look at the difference since 1950. So this is saying, hey, next year, next year may not be so great. Uh, Equity positioning has risen significantly off the bottom, but is still far from below February levels and remains underweight. So we're still underweight. We still have room to go. Now this one I thought was pretty interesting. So shared TV consumption, traditional versus streaming. Streaming is actually overtaking it, right? So who does the streaming? Well, Disney, Netflix, right? Yeah. So we're this I thought was really cool. There will be a point where this traditional is going to be down here at 20, and I think this other stuff will be up near 70 and 80. Oh yeah, here's the percentage of mortgages. So 81% are below 6%, right? You just don't have a housing crisis, in my opinion, with these type of rates. Like what is this? 60% under 4 to 5. Um, this is just capex from hyperscalers. You can see who's spending the most. That's going to hurt the profit levels of the Max 7, which is going to shrink their percentage of earnings returns. Um, so this one's from Carson. He's saying S&P performance after a negative quarter 1 and then a 10% quarter 2 above, and these are your returns. So quarter 3 for 100%, 100%, and final 6 months, they're all batting 100% with averages of 7 and then 16 at the end of the year. I think we'll probably somewhere close to that. I think probably, depending upon AI and the speed at which it's doing it, probably 13. This is from All Star Charts. I forgot the guy's name, but this is a beautiful little rounding bottom here, the ETF for the transportation. right? We always like it when transportation breaks out. And then Alibaba ready $7 billion boost for commerce plans for new data centers. Let's see. So one of the things, if you're an investor in Alibaba, is understand that they are sacrificing some of their profits to invest as well in AI. And I'm glad they're doing that. And here's another thing about Trump. That was supposed to be a part of the big beautiful bill, but they took it out. And then I think Mike Lee was going to do something with it, and that didn't work. But what this article goes into to tell you is that you you still have a way that Trump can do that without going through Congress and getting it all passed. So I think what's going to end up happening is you're going to have smaller homes being built on this type of land. And so instead of the average home being, whatever it is, like let's say it's 2,000 square feet, maybe it drops down to 1,500. That way you can lower the cost through size and you can lower the cost through this land development. Um, and this one is California dismantles landmark environmental law tackling the housing crisis. So basically, what they did is California's got these environmentally friendly rules and laws, and they're actually saying, "Hey, we're going to get rid of those for now to allow for more homes to be built." um, and then this is just talking about Disney. Now, this guy right here, his name is Mark Newton. He's a part of Tom Lee's group. Um, and he was just showing here that you actually have some bulls. Bulls are starting to get higher than the bears now. And in his mind, what he thinks is going to happen is he thinks that we're going to have a little pullback this week. And one of the things that he follows is this put to call ratio. I don't know how many of you guys follow this, but when it gets down here to this 0.45 level, that usually reaches a top. And then when it gets up here near the 1 level, it's usually a bottom, right? And so where are we now? We're at 0.55, 0.5. So maybe we got a little bit more room to go before it starts to give us a little bit of a pullback. Um, yeah, so this is kind of what he's looking at here. He thinks the pullback's going to be shallow as well, and maybe pull back to 6,000, and then we go. Again, this is just showing July. Great month to be a trader. And this is Carson again saying, hey, if we're higher in May and June, the rest of the year does very well. So you can see all the data points pointing to continued strength throughout the year. And then bottom up EPS is 300 next year, right? So we're still growing, and I think that's actually contained. This is just showing from Charlie Vallejo that we're above where we normally are on an average return. We came all the way down here and just shot right back up. One of the fastest gains, and you can see all these other times 6 month, 1 year, 2 years out, they're all green except right here, right? So again, more data pointing to continued strength. This is just showing the international versus the U.S. stocks, and again, I think this will continue. I think international will outperform. You'll have U.S. stocks doing 6.2% with them doing 20. I think stuff like this will continue. Maybe the U.S. stocks do 10 or 12 and 13. Maybe they do 15. You know what I mean? But I think these guys are going to be outperforming the U.S. We just have a lot of catching up to do. I mean, look at this. This is crazy. 10 years of the stocks versus U.S. stocks versus the world. And I've got another chart. I don't know where it is, but it shows like the U.S. makes up like, I don't know, 80% of the capex for the entire world, but only like 65% of the earnings power. So that's stuff that we have to keep track of. Um, so this was showing who led the recovery, and this is what I was talking to you guys a lot about. People will dump tech very quickly, but anytime that tech offers it doesn't have to be a great price. If tech offers a good price, you're going to get a lot of buyers. Now, if you have a recession and you don't know if COVID's going to kill everybody, then yeah, tech's going to continue to go down just like everything else. But I don't ever look for great prices on great tech companies. I just look for good prices, right? Like buying Nvidia around 100, absolutely, I love it, right? That's not a great price, but I'll do it every time. And that's because whenever the opportunity comes for people to buy the great tech companies, they do, and they lead the charge. um, this is just talking about unemployment, right? We're moving up on unemployment, which is another reason Powell needs to cut. This is just showing that what's going to happen is AI is going to start taking over, and you're going to have a lot of companies that are going to have a lot less employees. Changing employees over 10 years. You can see all this. This is going to really start shrinking down. And it's still, they're going to keep their revenue and profit up. And so this is the forecast for CPI, core CPI, and core PCE. So the reason you want to keep track of this is, this is what they're expecting. Does it come in hot? Does it come in cold? They're expecting it to come in hot because of tariffs, and which makes no sense to me because tariffs aren't going to make it come in hot. But what will make it come in hot is the increase in money supply, and they're printing money now, so that's going to be why it's hot if it's hot. Now this chart right here is pretty interesting because you can read into it where we are from a valuation standpoint. Do you see how as we get down close to this 1 point range, it's like this shows a low dividend yield because why? Because the SPY is getting so high in price that your dividend yield is low. If it drops in price, then your dividend yield will go up. So this is just another way to show that the SPY is getting into an area where we could get a little pull. We need earnings to come out to raise targets. People raise dividends, right, to help offset some of this top level. And then this is just year over year private sector jobs growth. They were talking about this last jobs report being okay, and it's not, in my opinion. It's this comes from a guy named Scott Grains. He runs a blog site, and he talked about it a lot too. Um, but private sector job growth is not looking great, even though Trump's kind of touting it that way. But it's another reason that we need to start cutting rates. Okay, so that's the data that I wanted to run through. I'll stop this recording. Does anybody have any questions?